Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Dominic in for Bob Pisani today. We're joined by Tim Seymour of Seymour Asset Management here with me at the New York Stock Exchange Post 9, and also Christian Magoon, CEO of Amplify ETFs, coming to us from Colorado Springs, Colorado. Let's start today with Apple gearing up to report earnings tomorrow. It'll be a big one. After the closing bell, that stock is up 30% this year. Its results could move the needle in the markets in a pretty big way. Apple currently sits more than 250 and traded more than 250 ETFs, roughly 290 million shares in the market overall. Some of the ETFs with the most exposure to Apple include, of course, the XLK, the Spider S&P Technology ETF, Fidelity's MSCI FTEC Tech ETF, and the iShares IWY, to name a few. So what is the best way to play Apple earnings using exchange-traded funds? Tim, we'll start with you. Apple should just be a standalone trade because it is that big, it's that big of an influence. But folks use ETFs increasingly more, especially with regard to technology. So how exactly, as an asset manager, do you view these ETFs when it comes to a proxy for Apple?
Well, first of all, great to be on the ETF Edge, because this is the kind of a question people need to understand. And the XLK at 17% weighting just in Apple alone, despite the fact that there's some very big and powerful tech stories that make up market cap almost as much as even that. I think, ultimately, when you think about the triple Q ETF, that which is the NASDAQ 100, and you still have Apple's almost 10% of that weighting, you better have a view on Apple going into earnings. So Apple reports tomorrow after the bell. A lot of this really is pick your ETF based upon your view of Apple, right? So I'm long Apple. I believe that the services revenue profile is something that will continue to quietly move higher, even though I think it's gotten a little too much exposure right now. I think you have to get back to a company that has enormous capital markets flexibility. They can actually continue to buy back shares and do things that will certainly boost a return profile. And I think as we get into the third quarter, the iPhone shipments number is going to be something that people actually have to boost higher on their estimates.
Christian, do people out there, investors, especially on the retail side, do they have to pay attention to just how heavily weighted some of these funds are in a stock like Apple or a Microsoft or some of these other mega cap technology names? And if so, why exactly is it important to do that in the different range of ETFs that are offered out there?
Yeah, so one of the benefits, Dom, of ETFs is the majority of ETFs show their holdings. They're transparent. So on any given day, you can see just how much of a percentage Apple is or Microsoft is in a technology ETF. And that tells you, what your exposure is in these moves. And certainly for funds that have 17% or 15% of Apple exposure, tomorrow's Apple's earnings are going to be very important. The other thing you need to look at is cost, certainly. These ETFs all have different expense ratios. Looking at XLK, it's got the most Apple exposure at 17%. But it's priced at 13 basis points. Moving down one ladder, FTech is a 15% Apple exposure, but it's priced at 8 basis points. So you have to weigh those factors, exposures and costs, when looking at the right ETF to play different companies' earnings or exposures.
So Tim, let's toss it back to you. Is there a way that you prefer? We look at things like equal weighted or overweights in certain parts of the market. ETFs are index tracking for the most part. Is there a way that you are looking to play Apple? And if so, which particular ETF would you rather be looking at? Is it just simply the most heavily weighted one with Apple?
Well, first of all, I'd like to be in an active ETF, just to be clear. I mean, I know that the Amplify guys have a lot of very active ETFs that I think can be both thematic and timely and tactical. So, when I think about Apple, this is also a stock, frankly, that going into numbers has had a huge run. And I think expectations went from being overly negative and people looking at the downside in terms of their flat to slightly decelerating top line. So, ultimately, at the end of the day, I'm a stock picker. I want an ETF that I need to know what's under the hood. Christian talked about the expense ratios. Frankly, I think most investors are agnostic on what it costs them to own that unless it's really an outlier. And I think, frankly, if I have a management team behind that ETF that's doing good things on the active side, I'm willing to pay for that.
Well, it seems like such a long time ago, just the beginning of this year, when we heard about the revenue takedown that Apple issued its new guidance, and it seems like that stock has run so far, guys, since then.
It really has.
But certainly, guys, Christian and Tim, those thoughts on Apple, we appreciate it. Moving on now to the retail side of things. Breaking out this year, but it's in a number of e-commerce names that are really leading the pack in this particular trade. Check out some of the top performers this year in the popular Spider Retail ETF, the ticker XRT, Carvana, Wayfair, Stitch Fix, all up more than 50% or more in 2019. And then there's the behemoth, Amazon, up around 30%. But it's not so much of a behemoth in this ETF. So are these one-click wonders, or so to speak, the other ones, the best bet in this particular space? Christian, you run the IBUY ETF, focused on global online retailers. It is on the smaller side, but it's up about 30% or so this year. Tell us about that, and tell us about why it's different, that and the XRT versus other indices, tracking instruments in consumer discretionary and retail, Christian.
Yeah, sure. So IBUY is the first and largest ETF focused exclusively on online retail stocks around the globe. There's actually a revenue test to be a stock included in the ETF. You have to have 70% or more of your revenue from online or virtual sales, or the Amazon rule, you have to have $100 billion or more of revenue from online sales. So it's a very pure play for online retail stocks around the world. So you see all these winners so far this year are top holdings in the online retail ETF, unlike XRT, the broad-based S&P retail ETF that has bricks and mortar as well as some clicks. This is exclusively focused in this fast-growing area of the market. We just saw the U.S. retail sales report last month in March. Online sales grew 11.6% year over year. Department store sales were down 3.6% year over year. Clicks are winning over bricks. It's a trend. IBUY is the #1 performing consumer cyclical ETF over the last 3 years and has generated a return over 100% during that time. The traditional retail space has languished, only up about several percent during that exact same time period over the last 3+ years. So we think online retail is the theme to invest in. It's a global trend. We think brick and mortar might be a trade in some cases. There's definitely some sentiment that has popped in some cases, but also dropped majority of the time over the last 3 years. So we think that's a trade versus an investment for the online retail space.
All right, so Tim, the reason why I wanted to highlight this is because in the intro I mentioned that massive run in Amazon shares. Yeah. But Amazon does not play all that much, or on a relative basis that much, in the XRT or the IBUY. Take us through that reasoning why, the equal weighted versus the market cap weighted, and is there a trend that you see developing with regard to Amazon versus everybody else out there?
Well, I would maybe even prefer to answer it. So look, like Apple in the XLK, there are ETFs that choose, and Christian and Amplify's ETF in terms of the iBuy has gone after those players that really are exposed to purely online retail. The problem with investing in an XRT, or maybe the benefit of an XRT, is not only is the equal weight does not allow the manager, it's an index, let's face it. But as a guy that also historically has run a long-short equity portfolio, a lot of people use the XRT as some type of a hedge or a measure of cyclicality in the global economy. Look, it's underperformed the S&P by about 500 basis points year to date. Why is that? Not because I think the composite of those companies are, yes, they may be a little bit more bricks and mortar over clicks, but I think a lot of this is a call on where we believe the economy is. And let's face it, despite the fact that the market's having a great run here and we're all-time highs, that's more a function of people actually fearing, I think, this tick higher. So know what you own with the XRT. This tends to be a high correlation to growth. As an EM guy, historically, I would short the XRT against it because it's very highly correlated with emerging markets.
So Christian, the equal weighted versus market cap weighted approach, we mentioned this a number of times in the world of ETFs. Do you see anything on your side that would suggest it is some of these smaller pure play online retailers that will really be the outperformers, or is just Amazon the way to go because it is the 800-pound gorilla in the industry?
Yeah, it's a great question, because we've seen even this year that Amazon isn't even a top 10 performer in the online retail space. It hasn't outperformed companies like Chegg or Etsy or Wayfair. Amazon isn't always the #1 performer. Why? Because it has a really diversified business, whether it's AWS Cloud or some of the spending they're doing to build out infrastructure for deliveries. It's a unique stock, and it certainly has had an unbelievable return, but it also has a lot of risks and volatility associated with it that aren't specific to online retail. So we think taking an approach to equal weight this online retail space allows you to have exposure to Amazon, but not to be overly weighted, and discover companies like Carvana, which is a top holding in iBuy that many investors aren't that familiar with, that's gained over 90% over the last year. So discovering new online retail companies is what iBuy is all about, and it's been able to deliver significant alpha both against the traditional brick and mortar, but even this year against a company like Amazon.
All right, Christian Magoon, thank you so much. We're going to leave it there for that discussion on retail as well as what's happening with financials. Thanks so much for joining us here today. Let's end, though, on innovation. Wall Street is getting serious about industry disruption, and there are a handful of ETFs focused on just that. ARK Invest products are built to capitalize on disruptive forces like artificial intelligence, perhaps robotics, genomics, next generation internet, you name it, and the woman behind them is here with us today. Kathy Wood is the founder, CEO, and Chief Investment Officer at ARK Invest. She joins us here now at Post 9. Kathy, thank you so much for being here.
Great to be here, Don.
So Tim had earlier mentioned this idea of actively managed ETFs, the ones that don't necessarily track just the S&P or some broader index. Is it fair to characterize ARK Invest as one of those actively managed types ETFs?
Yes. We trade practically every day, so we're very active.
So what does that mean when you trade every day? Because there's this idea that passivity or index tracking is what ETFs are all about. They become synonymous, but that's not necessarily the case.
Right. In 2013, I thought the same. I didn't think ETFs had anything to do with what I do. And we started looking into the wrapper and found there was no reason, as long as we were willing to disclose our holdings at the end of every day, there's no reason we couldn't do an active ETF, active equity ETF.
And take us through the strategies. We mentioned that you tilt towards the disruptive type technologies. What exactly does that mean? How exactly do you hone in on the stocks that go into these actively managed exchange-traded funds?
Sure. Well, our screen is not a benchmark. Our screen is our research. Our starting point is from the top down, and we're looking for learning curves or cost curve declines that are associated with technology, and they're fairly consistent over time, depending on the technology. And from a timing point of view, we want to make sure that we're ready for prime time, so we ask the question once we figured out the cost decline, okay, for every percentage point decline in price, how much does demand increase? Are we ready for prime time? So in the late 90s, if we had asked that question about most of these technologies, the answer would have been no. And yet investors were chasing them and valuing them on eyeballs and other such things. Today, they are happening. We're ready for prime time. And the fear I see out there when it comes to volatility or disruption or anything that's not in an index is palpable. That's the real opportunity. The dream was too early. Anyone who chased it got burned. Today, they're afraid. They should be moving into it.
So Tim, you opened the door to this discussion when you brought up actively managed ETFs.
Yep.
So as we talk about it, I mean, you're an active trader. You are a trader on fast money. So how exactly do some investors or even asset managers look towards creating products and then actively trading the portfolio to create value that is then passed on to the holders of those particular instruments?
Look, if as an investor you can invest alongside of a manager, invest in a manager who is actively monitoring a portfolio and going through the same stress testing that a long-short equity manager, for example, which is what I did for 13 years, is doing, you're getting the best bargain in the business. That's when you really have to ultimately understand who you're investing in. So to the extent that managers like ARK Invest can be taking this area of the economy where there's enormous innovation and where there's an opportunity, I think that's fantastic. The question really is, do investors totally understand the investment approach of the manager? And I think it's great to have Kathy here because I think there's some controversial stuff that she's been involved in.
Well,
that I think we
let's
can
talk about
understand
that because the reason. So Kathy, for better or worse, because there's always two sides to a story, you at ARK Invest have become very closely associated with one stock in particular, and that is Tesla, because you made a lot of waves by attaching a $4,000 price target to the shares at one point.
Yes.
This means that you are obviously very bullish on Tesla and you do hold it in the funds. Is that correct? And if so, is it just a buy and hold, hope it pans out for the next 20 or 25 years? Or is it something different in the way that you approach this particular holding in Tesla?
It is our largest position, but before I go into that, our conviction has increased in the last year or so. It's our largest position. It's down about 29% this year, and it's always been our largest position this year. And yet our fund is up 28%.
How is that? How does that happen?
Yes.
How does that happen?
It is because last year, when genomics was under assault because of reimbursement concerns and pricing concerns and so forth, we were leaning into those heavily. So you buy low, right? We were leaning into those. And so our second largest position, Invitae, which we think is one of the most important molecular diagnostic companies out there, riding down the cost curve of DNA sequencing, it's up 125%. It got as low as $5 last year. Today it's $18. So leaning into that has really paid off. And it's true with the entire genome sector. We're doing the same this year with Tesla, but our conviction level there is so high that it never left our top position.
How could it be so high? I mean, Tim, this is a stock that is, if you look at a chart of Tesla over the course of the year to date and the 1 year period, this has at best been a roller coaster ride.
So,
at worst been one that's trending lower.
But first of all, it's great to have you here, and congrats on the performance in the portfolio, because I think there's no question there's an active component to what you're doing, and I think I would like to invest alongside of that if I was an investor. With Tesla, I guess there's two questions. I think there's been some obvious issues in terms of performance and some obvious issues on the balance sheet, but that's my interpretation. It may not be yours. The first question I have is really just corporate governance risk, because I look at a company, leaving aside an SEC investigation that one might argue is overdone. I think it's a company where disclosure and consistency and the same standards I would hold to any company, somehow for this company, no one seems to hold them to it. And how do you approach corporate governance?
So we have a 6-point scoring system. All of them incorporate ESG in some way, shape, or form. First one is people management culture. Nothing bothered us about what Elon was tweeting or anything until funding secured, which once we found out that was not true, we said, okay, that's not good. And so we did ding Tesla for management when that happened.
Does that mean a higher discount rate? I mean,
yes.
Mechanically, what does that mean?
Yes, but you know what our target is.
Right.
It's
not going to really move.
No.
Yeah.
But within a month and then 3 months, 2 of our other scores started soaring. One was we learned about their artificial intelligence chip. We saw the specs. Right. And our analyst, James Wang, came from NVIDIA. That's what they're replacing. And he said, oh my goodness, and he's going to write something this Wednesday about it. This leapfrogs the competition. Yeah. And they're at least 3, if not 4 years ahead of the competition. And then a few months later, execution went up when not only did they not lose in the third quarter $700 million, but they made, this is cash flow, $1.4 billion. So that was a miss in terms of consensus expectations of roughly $2 billion. That's what happens with exponential growth.
So Kathy, though, I mean, let's put this in perspective also. The stock is down for a reason, partly because there's a fear of a possible capital raise that has to happen down the line. Yeah. They may have to issue more stock, raise more money, and that's going to dilute existing shareholders. Are you concerned about that aspect of Tesla, that they are burning through cash and that they need to raise more, and that could put pressure on the stock?
Well, I believe that's in the stock.
Or would you welcome that?
Exactly.
Is really a question I have, because what I wonder is why this is a company who has enormous cash burn and an enormous opportunity. This is the $1 trillion idea with $1 trillion worth of issues around it. Yeah. And I would be out there raising money tomorrow. Can the company not raise money?
Sure. Oh, it can raise money. I don't think Elon wants to do it at this valuation. I think he thought, and the company thought, that their autonomy day last week was going to give them a nice opportunity, that once analysts understood how far ahead of the competition they are, whether it's Waymo or Cruise, in terms of autonomy, and how soon it is going to evolve, and that they would be able to raise. What happened last week came clear to me is the analysts following this stock don't know how to analyze it, because it's not a technology stock. It is that. It's not a car company. Yes, it is. Battery. It's utility. It's something for everyone, and no one can pull it all together. We have set out our research teams. We have broken them out not by sector, but by innovation platform. So we have a robotics autonomous vehicles or robots. Energy storage, they will be electric. Artificial intelligence, they will be powered by artificial intelligence. Transportation as a service, we have 4 analysts collaborating on this. I don't think research departments out there are set up to analyze this stock. There is an amazing inefficiency in this stock. It is our highest conviction idea for a reason.
So let's do this. Tim, you as a manager and a former long-short portfolio manager have traded around positions, trimmed, added to, that sort of thing. Is it fair to say, Kathy, at ARK Invest, that just because Tesla is your top holding, that you just hold it there, or are you constantly managing around that position in and out?
So disruptive innovation is characterized by controversy and volatility. And so we know we're going to get opportunities to buy stocks. We lie in wait for those opportunities. Many people think of, because of what we do, disruptive innovation, that we're momentum driven. Absolutely not. We lie in wait. So if you just take Tesla alone, 2018, you're right, the roller coaster. If you take away the performance of the stock, which was up last year, just take that away and just look at what happened, what we delivered in alpha because of our trading around controversy. We delivered 175 basis points just from Tesla. And we get opportunities like that throughout the portfolio.
And I think that's impressive. And I think that's kind of a manager that I would want to be tactically, along with a fundamental view, invested with. I would push back on that volatility. First of all, congrats for laying in the weeds and buying stuff cheap, and that it's been proven out this year in your portfolio. But I look at a stock like Tesla, and over a 5-year period, the stock's done nothing, with being one of the most volatile stocks in the world, at least of the mega cap stocks. So I look at, and I could cherry pick numbers, but I could say, really off the high of 2014, you're down 20% by holding Tesla for 5 years when supposedly it had a huge competitive advantage. Yeah. There was no competitors in their space. Right. It was being priced as a technology company. And the stock really at a point where now it looks like there's some balance sheet issues. The competition's never been heavier, although I think you'll push back on that. I think I appreciate your argument, which is that they're not an auto company. They're not a tech company.
But even more, just let's take the electric vehicle. The Model S, 2012 it was launched. Yep. Not one of those competitors is anywhere near it. We're 7 years later. Now let me take your other point. This trading around, this trading range, you as a trader and investor, but as a trader also, understand that when you build a base like that, one of 2 things is going to happen. It's either going to break down, and that's what a lot of the bears have been betting on, and they've been throwing everything at it, or it's going to break out. Clearly, we believe it's going to break out. And the longer the base, you say 5 years, the longer the base, the bigger the breakout. So we're really looking forward to that.
It's a fascinating discussion, one that could go on for hours, I'm sure, guys. Yeah. Unfortunately, we should do this again, guys.
Okay, great.
Anyway, that does it for this week's ETF Edge. I'm Dominic Chu, in for Bob Bassani. My thanks to Tim Seymour, also Kathy Wood and Christian Magoon for joining us today on the show. And thank you all for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a great week.